Unless you've been living under a rock, then you've likely been hearing the word recession lately. Defined as a fall in GDP in 2 successive quarters, the United States is currently in a recession. On top of this, inflation continues to increase at high levels, with a reported month-over-month increase of 0.4% in September. This all but guarantees continued high interest rate increases from the Federal Reserve through the end of the year. All of this has combined to produce a stock market crash in 2022, with the Nasdaq down 33% year to date and the S&P 500 down over 23%. If that's not enough, you can toss in war, massive debt, etc. Despite all this economic uncertainty, I regularly see stocks growing their dividend payments to shareholders. So why is this? In today's video, I'm going to analyze how many businesses continue to grow their earnings and dividends throughout times of economic turmoil. This will include a clip from Warren Buffett addressing how he thinks about investing in uncertain times. Additionally, I will provide historical and current examples of companies who continue to grow their dividends year after year. I'll even dive into some of the characteristics that help make this happen. At the end of the video, I'm going to share some of the latest examples of great companies growing their dividends right now. Let's roll the intro. My name is Zach, and you should leave a like and subscribe to the channel if you enjoy the video. Also, check out dividenddata.com for access to many of the research tools I use. As I mentioned earlier, the current economic environment is quite uncertain. However, that should not stop you from investing altogether. In the following clip from the 2004 Berkshire Hathaway annual meeting, Warren Buffett answers a question about investing when there are negative macroeconomic concerns. Many of these may seem familiar if you follow our current market drama. History tends to rhyme.
In view of the Iraq war, consumer debt that's increasing, declining job growth, declining pay in the jobs that are growing, prospects of increased interest rates, he has this view that the next 5 to 10 years are going to be very difficult. What would your view be about this, the investment future for the next 5 to 10 years in view of all these negative factors going on?
That's too soft for me. I think Warren should take that.
Well, I would say that at any given point in history, including when stocks were their cheapest, you could find an equally impressive number of negative factors. I mean, you could have sat down in 1974 when stocks were screaming bargains, and you could have written down all kinds of things that would have caused you to say, you know, the future is just going to be terrible. And similarly, at the top, you know, or any time you can write down a large list of things that would be quite on the bullish side. We really don't pay any attention to that sort of thing. I mean, we have, you might say that our underlying premise, and I think it's a pretty sound underlying premise, is that this country will do very well, and in particular, it will do well for business. Business has done very well. You know, the Dow went from 66 to 10,000 plus in the 100 years of the 20th century, and we had 2 world wars and nuclear bombs and flu epidemics, and you name it, Cold War. There are always problems in the future. There are always opportunities in the future, and in this country, the opportunities have won out over the problems over time, and I think they will continue to do so absent the weapons of mass destruction, which is another question, and business won't make much difference if anything really drastic happens along that line. So I can't remember any discussions Charlie and I have had ever going back to 1959 that where we would have come to the conclusion at the end of them that we would have passed on a great business opportunity, a business to buy, because of external conditions, nor did we ever buy anything that we thought was mediocre simply because we thought that the world was going to be wonderful. It won't be the American economy, in my view, that does in investors over a 5 or 10 or 20-year period. It will be the investors themselves. If you look at the record of the 20th century, you'd say, how could anybody have missed, in owning equities during that time? And yet, we had all kinds of people wiped out, in the 29-32 period. We had all kinds of things that were bad. But if you would just own stocks right straight through, didn't leverage them, you'd have gotten a perfectly decent return.
Warren Buffett always has his primary focus on the business itself. While it's important to be aware of macroeconomic factors, investing always comes down to the productivity of individual businesses. On a long time scale, investing in a group of high-quality stocks will most certainly generate respectable returns. From the 2004 date of that Warren Buffett clip to today, the total return of the S&P 500 with dividends reinvested is over 364%. That's an annualized return of 8.693%. Keep in mind, this is after the market has fallen over 20% from the 2022 crash. In that same time, the annual dividend payout of the index has grown at a 9% compound annual growth rate. If we look at the dividend growth rate year by year, you can see that the index tends to see consistent positive growth year after year. However, in some recession years like 2000, 2001, and 2009, there can be a decline in dividend payments. It's worth noting that this is not reflected so far in 2022. But Zach, I thought you said dividends grow in recessions. Well, not every company will, but there are many examples of those with robust business models who can. For example, there are the dividend aristocrats. This is a group of companies who have increased their dividend payments every year for at least 25 consecutive years. There are also the dividend kings who have increased their dividend annually for at least 50 consecutive years. These are stocks who have stood up against the test of time and grown throughout decades of economic changes. Examples include PepsiCo, McDonald's, Coca-Cola, Procter & Gamble, Lowe's, Johnson & Johnson, etc. I actually made an entire video going over all the dividend aristocrats linked here. On top of this, there are many other great companies who will continue growing throughout recessions and well beyond. These are likely to be the future dividend aristocrats. I believe companies like Microsoft, Apple, Visa, MasterCard, and Texas Instruments fall into this category. There are many others we could name. Microsoft, for example, is one of my favorite holdings, and they just recently announced a 10% dividend increase. I see high growth continuing well into the future for the company. Texas Instruments is one of my newer buys, and they recently announced a 7.8% dividend increase. This company has a strong competitive advantage in the analog semiconductor market and will continue to grow well into the future. Visa has been having strong earnings and will announce a big dividend increase soon. It's important to remember that there are really strong companies out there who have growth trends that will march on despite macroeconomic concerns. Another stock I own, PepsiCo, just reported a strong quarter in this fearful environment. They beat analyst expectations on both revenue and earnings and hiked its forward-looking forecast. PepsiCo owns extremely popular snack and beverage brands, giving them pricing power. This is great, especially in times of high inflation. The PepsiCo CFO was just on CNBC and had this to say about the quarter.
We saw revenue growth of about 16%. That includes the higher prices. Volumes or units that we sell were up just a bit on the quarter. So passed along a bit of inflation. Obviously, our commodity costs are up even more. And as a result, gross margins were down a bit. But then we managed the balance of the cost structure pretty tightly. So operating margins were actually up about 30 basis points. So it's a combination of, look, we invested in our brands. We're actually seeing good consumer response despite the fact that we've had to increase prices. And we've got our cost structure under control very well. So we delivered a superior result. In a world that's obviously stressed economically, as you guys have been talking about all morning, the one thing that consumers know is they may not be able to afford big ticket items like houses and cars and personal technology, but they can afford a simple luxury like a bag of chips or a beverage. We've actually gotten pretty good at cost control while we're growing the top line well. Part of that, candidly, is we're trying to prepare for what could be a tougher future from a consumer perspective, and if it is, we'll be ready for it. But frankly, if it's not, you'll see quarters like the one that we just posted where we're controlling cost and we're getting great top line. So we're trying to control what we can control.
PepsiCo is an example of a company that will remain strong in nearly all economic environments. Their high-quality brands and competitive position allow them to be resilient against inflation. Earlier this year, the company increased their dividend just under 7%. This is a great dividend increase for a slower growth company like PepsiCo. PepsiCo is just one example. Other companies I own, like Coca-Cola and the Altria Group, share these consumer pricing power characteristics. Even though Disney has had their dividends suspended since 2020, I would say the company is one of the best examples of pricing power. They just announced more price increases on their theme parks and streaming services. When the company starts paying dividends again, I expect this to be one with reliable dividend growth. As a dividend growth investor, my goal is to identify companies who I think can sustainably grow their dividend well into the future. Let's look at some more examples of companies who are growing their dividend right now. To do so, I'm going to be using the Dividend News tool that I built for dividenddata.com. If you visit that page, join our Discord, or follow me on Twitter, then you can get notified of the latest dividend news as it happens. If you're a paid member of dividenddata.com and track your portfolio, then you can get this news filtered by just the stocks you own. For example, here's the latest news in my portfolio. So which companies have been increasing their dividends in recent weeks? Well, McDonald's, ticker symbol MCD, just today announced a dividend increase of 10.1%. This was a surprisingly large increase for the company and likely a signal that they feel strong about their near-term economic prospects. A.O. Smith, ticker symbol AOS, just increased their dividend 7.1%. Intuit, ticker symbol INTU, just increased their dividend 14.7%. This is a great dividend growth software company that I've considered adding to my portfolio. Lockheed Martin, ticker symbol LMT, increased their quarterly dividend 7.1%. Honeywell, ticker symbol HON, increased their quarterly dividend 5.1%. Starbucks, ticker symbol SBUX, increased their dividend 8.2%. Starbucks is another great company that I've considered adding to my portfolio. Illinois Toolworks, ticker symbol ITW, increased their dividend 7.4%. All of these dividend increases are worth researching, and let me know if you want a full video on any of the companies. If you're a member of dividenddata.com, you can use the research tool that I built to show all the financial characteristics that I look at when analyzing a company. There are many great businesses who will continue growing well into the future. The bright spot of the 2022 stock market crash is that I'm able to buy some really good companies at cheaper prices. The lower the price falls, the more my earnings and dividend yield on cost rises. If you want to see what I'm doing, check out my latest portfolio update video linked here. This is of course just my opinion, and be sure to do your own research before making any investment decisions. If you like this content, please subscribe to the channel and check out my website dividenddata.com. Links in the description and pinned comment.